Alright, hello everyone, welcome back to the channel. This is Emil. In this channel I mostly talk about investing, particularly in the stock market. So if that interests you, consider subscribing, and with that said, let's get straight into it. So as you can probably tell from the title of the video, today we're going to be talking about index funds, or ETFs. So I'll just run through the pros and cons of investing in index funds quickly, and then we'll move through my top 5 favorite index funds in ascending order, with my favorite being at the end. So make sure you stick around for that. Okay, so I think it was a bit too bright there, so I closed the curtains. I assume most people know what an index fund is, but if you don't, I'll briefly explain. It's basically a collection of stocks, the most famous of which being the S&P 500. So that's a proportionally weighted, you buy one stock, one share of the S&P 500, and within that there's the 500 biggest stocks in the US market, proportionally by their size. So you're not going to have the same amount of each company, you're going to have a proportional amount. Like, it's mostly going to be dominated by Apple, Amazon, blah 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 blah, by the biggest companies. So that's quickly what an index fund is. Now, why do people like to invest in index funds? Well, it limits your risk in the fact that if you invest in one individual stock, there's always the chance that it could go bankrupt. Whereas if you invest in a basket of stocks, the whole basket of stocks isn't going to all go bankrupt. You're not putting all your eggs in one basket. Furthermore, most people know that hedge funds and mutual funds actually underperform the market indexes, especially when you take fees into account. So index investing has become very popular, and I think the popularity is warranted. It's much easier as well. You don't have to think about investing. You don't have to do as much research when you're investing in an index fund. If you're individually investing, you have to manually go research the company, make sure the balance sheet is okay, what are the growth potentials, blah 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 blah. But if you're just investing in an index fund, you don't really have to do that. So it's great for people who aren't interested in stock market investing, or don't have time to. So you can just set it and forget it. Just buy the index fund, and if you leave it in for long enough, it'll be worth more than it is now. That's always been the case up until now, so I can't really imagine it changes as long as you're long-term investing. Lastly, the fees are much lower than a mutual fund. And I'll just quickly run through some of the disadvantages to investing in index funds. If you're really good at investing, kind of wasting your talent if you're investing in an index fund. If you know that certain stock's going to do really well, or you think a certain stock's going to do really well, but instead you invest in an index fund, an index fund doesn't get those crazy 2x's or 10x's in a matter of years. You have to wait a really long time to see big gains in your returns. However, if you're individually investing, there's always a possibility that you could do really well in just a couple of years. And if you manage to beat the market, so say the S&P 500 has averaged 10% a year, but if you manage to get 12% a year, compounded over 20 or 30 years, is an enormous difference. Okay, so now we're looking at a return for the S&P 500 at 10%. $1,000 turns into $53,000, so that's pretty good. Let's see what happens if you just beat the market by 2%. So $53,000. Instead, we would have got $118,000. Yeah, basically, if you're young and have time if you're interested and really like researching companies, it might be to your advantage to start learning how to invest now and find individual companies. Because if you get that 2% extra compounded over that much time, it can really help. However, it might take you a few years to be able to beat the market. You need experience. Alright, let's start with the indexes now. The first one here is VBK. This is a growth index fund. So basically it has a collection of small cap growth stocks. In the past, small cap growth stocks, a collection of them, have beaten the S&P 500, or has done pretty well in the past. So that's why I've put it in here. but we have to take into effect that's a factor, which means that like people know that now, that small cap growth funds do better, or sorry, small cap growth stocks tend to do better than large cap normal stocks, or an average amount of stocks. So people know that automatically makes their likely return diminish or disappear, because people will be more likely to purchase those kind of stocks now that they know that it might do better. Just because it's done better in the past doesn't necessarily mean it'll do the same in the future. It's a little bit more volatile. You don't get any dividends, obviously, because they're small cap and they're growth companies. So yeah, that's the first one. It's might be worth throwing a little bit in there, see what happens. So our next index is SPHD, and it's a high dividend index. So it basically finds companies that have a really large dividend, and companies that have a high dividend usually have been hit pretty hard recently. So if you're investing in a company that has a very high dividend, it's likely that the stock has been beaten down a lot for some reason, because generally stocks won't pay a dividend higher than 5 or 6%, but if they do, there must be some reason for it, and it's likely that that dividend might get cut, or the stock price is going to reduce in the near future. So it's a bit of a put-off seeing a high dividend in an individual stock. However, if you're doing it for a collection of stocks, maybe it's a little bit safer than just one particular stock. So this one yields 4.4%, which is very high. And because you're investing in an index, it's constantly buying and selling the different ones. So as the dividends get cut from different stocks, you'll be selling those. Well, you won't physically be selling it, but the index, the person who manages the index will be selling it. So your your high yield will remain the same, but maybe the stock price will fluctuate a little bit. So this is good if you want a high yield dividend without as much risk, although it wouldn't be my personal favorite. Yeah, I just mentioned there that in times of recession, a lot of those kind of companies that pay a really high dividend are more likely to go bankrupt than a standard company. Okay, I've already mentioned this second last index throughout this video, but yeah, it's here for a reason. It's the most popular one. It's has historically done extremely well. You also do get a nice little dividend as well of 1.7%, and I think it should be in pretty much most people's portfolio. I believe it's a nice way to track your progress, to see if you're beating the market, because most people consider the market to be the S&P 500. That's kind of the benchmark, whether you're outperforming or underperforming is the S&P 500. So I personally have probably like about 3% of my portfolio is in the S&P 500, maybe 5%. But yeah, I kind of just do it to track my performance and see how I'm doing. And it can't really go wrong with the S&P 500 unless you think America is gonna go down in a big way. Yeah, so that's all we really need to say about the S&P 500. And finally, we're gonna go to my. Oh no, sorry. There's two more indexes. Okay, so this is my second favorite index fund, and this is Noble, and this is a collection of dividend aristocrats. So Dividend Aristocrat is a company that has raised its dividend every year for the last 25 years minimum. So there's not a huge amount of companies that have done this. I'll just show you some of the companies that have done this. You can see there's a few companies here. You might recognize some of the names. 3M, AbbVie, Abbott. This is all in alphabetical. So these are big companies that have been around for a long time, that are pretty safe as far as stocks go. They're not going anywhere anytime soon. And the nice thing about this index and these stocks is that the dividend is it's so unlikely that the dividend will be cut in a recession or at any other time, because all of these companies have raised their dividends for 25 years. So they really want to keep that going. So this dividend is probably going to continue increasing through thick and thin. Even if one company doesn't raise its dividend, it gets kicked out of the index, and then you'll still have all the other ones that have been raising their dividends. So your dividend is guaranteed to stay the same and guaranteed to increase pretty much. However, the stock price might fluctuate a little bit, but also even in times of recession, it is fairly safe, probably a little bit safer than the S&P 500, for example, because in times of turmoil like we're in at right now, the S&P drops 20%. If people want to stay invested, like not everyone's going to sell all their stocks. They're probably going to sell the more risky stocks first. So stocks such as 3M that have been raising their dividends, people might still want to keep getting those dividends in times like this. So they're not going to sell those stocks first. They're going to sell them last. So for that reason, this stock price won't drop as hard as other indexes. So you also get a nice little yield of 2%. So I think this is a great index for people who really want dividends, or people who want the money in 5 to 10 years, because the likelihood of you cashing out with less money than you put in is lower than for other indexes because of the reasons I've already explained. So you'll be able to cash that dividend and also have a fairly certain chance that your money's going to be worth more in the medium term, although the other indexes might be better for the very long term. Some of the stocks that make up the Noble Dividend Aristocrats, because they're Dividend Aristocrats, you're kind of paying a little bit of a premium for them. So a few of them are definitely a bit overvalued, such as Procter & Gamble, which is a crazy price to earnings ratio. But as long as people are paying that premium for the Dividend Aristocratic title, then I suppose it's fine, kind of. All right, with that said, let's get on to my final index, and it's not really an index, so I don't care if you complain. Doesn't bother me, to be honest. But yeah, the last index in quoted is Berkshire Hathaway. Yeah, as some of you might know, or most of you might know, it's not really an index fund. I put it in here though because it's quite similar to the idea of an index fund, more like a mutual fund, except it's run by Warren Buffett and anyone can invest in it. So the reason I put this in here is because although it's not an index fund, it's returned historically, it's outperformed the S&P 500 many times over. So if you just look at the second point there, if you invested in the S&P 500, you'd have a 10% annualized return since 1964, whereas in Berkshire Hathaway you have a 20% return. Now, does that mean that you're going to get a 20% return if you invested in it now? I don't think so. Warren Buffett's picks haven't been as impressive as when he started investing. When he started investing, he was investing in smaller companies, which he can't invest in now because he is worth so much money now. Like, he has $120 billion in cash. He's probably deployed some of that for Berkshire Hathaway with this recent correction, but still, like, to have that much cash, you can't really invest in most companies. Like, you can't invest in a $6 billion company without pretty much buying it, the whole thing. So yeah, Berkshire Hathaway owns a lot of insurance companies and a lot of old companies, such as, I think their biggest holding is Apple. I think it's Apple, then I think Coca-Cola. They own a few, I think their second is Bank of America. They own Coca-Cola, Kraft Heinz. They own a couple of more banks and a couple of airlines. So Warren Buffett is a value investor, so he bought a lot of value companies in the 1980s that have done really, really well in the long term. So I think this is an extremely well managed mutual fund, but it's actually just a company, and it owns a lot of insurance companies which are very nice to own. because it's like a nice recurring revenue, and he has so much cash that he can always like pay out any claims that are required. So yeah, you can see the difference between investing in Berkshire. You get 2,000,000% since 1964 versus S&P 500's 19,000 or 20,000. So yeah, it's obviously a huge difference. You'd be a multi-billionaire if you invested $1,000 now in that time. But yeah, you'd be a little bit worried because Warren Buffett and Charlie Munger are so old, the two head honchos in Berkshire, that when they kick the bucket, which will probably soon, that Berkshire's returns may reduce, although they've mentioned this a lot in their annual, Warren Buffett always gives an annual letter to the shareholders, which I recommend you read if you want to invest in Berkshire Hathaway. But he mentions this worry, and has convinced me that they have pretty excellent management and people to take them over. So I wouldn't be too worried about that personally. So yeah, that's my favorite index fund after the Noble Dividend Aristocrats. So yeah, for the last point about the Dividend Aristocrats, they kind of give me a bit of diversification because my portfolio is quite tech heavy. Similarly with Warren Buffett's holdings, also diversifies me a bit because yeah, I know a lot about tech. Well, I think I do anyway. That's what I'm interested in. So a lot of my holdings are in those kind of companies. Whereas the Dividend Aristocrats, as you can see, they're 2% technology. Technology only makes up 2%. It's all kind of older sectors. Same with Warren Buffett's company. Apart from Apple, all his companies are kind of, 30 years ago companies. So it gives me a little bit more diversification in the areas that I don't know, but I still trust for Warren Buffett that he knows. And the Dividend Aristocrats, well, no one knows there, but like they're all big, old, profitable and well-run companies. Okay, I hope you enjoyed the video so far. If you did, please drop us a like, it'd be much appreciated, and consider subscribing. I'm just gonna give you some closing tips for investing in index funds, and then that's it. If you're investing in index funds, you're most likely not researching too much about companies. So I'd recommend just being a dollar cost average buyer of index funds. And if you want to go completely the index funds route, don't get bogged down by reading economic factors and things like that, because you can't predict anything like that. Although if there's a market crash, it's probably a better time to invest more. And if the market does seem a little bit overvalued, maybe you could tone down your investments a little bit. But probably the easiest thing to do for yourself would be just a dollar cost average the whole time, which means just to buy the same dollar amount of an index fund once a month or once every 2 weeks. So you get a nice average price over 5 years, and then when you sell in 10 years, you'll do very well. So index funding is obviously great. You're guaranteed to get a pretty good return, a very good return, and if probably going to do better than individual stock pickers like myself. So if you're an individual stock picker, you have to be okay with the fact that there's a good chance that you might not beat the market, but with a lot of work and dedication, you can do it. Alright, so yeah, that's everything I wanted to say for this video. I really hope you enjoyed. Again, if you could smash the thumbs up button, that'd be hugely appreciated. Subscribe, and I'll catch you in the next one. Cheers. Alright, hello everyone, welcome back to the channel. This is Emil. Today I'm going to be talking about index funds. So, alright, get that out of there.